Hello everybody. Can you perhaps let me know in the chat if you can hear me?
Hello, everybody. Thanks for joining us. Well, I'm looking forward to this conversation with Yuri today.
Okay, excellent. And then can you all could you all hear Professor Brunnermeier as well? Can you also let me know that? All right, hello everybody. We are live. Very happy that you are able to join us today. I'm with Professor Markus Brunnermeier from the University of Princeton, who is a very well-respected professor in the field of macroeconomics, finance, and all sorts of related fields, such as central bank digital currencies, but also now, the latest is resilience. Can I just ask you if you can see us in the chat and if that is all working? Let me just check, just to make sure that I don't start talking. No sound here. Is that still relevant? Mm-hmm.
I can see myself.
Okay, excellent. Let me just see if people can actually hear us. Very well, says Moses. Everything is working. Okay, thanks, Louis. That is great. Yeah, and Esker as well. Nice to see you. Okay, excellent. Everything is working. So that was my introduction of you, Professor Brunnermeier. But the thing is that you have also written a book now, which is called The Resilient Society. People already saw it, I think, in the opening slide there. Now, my question to you is, I basically have two questions. One is, did I do the introduction properly? And if I forgot something, please feel free to add it. But then after that, I'm really wondering, what is resilience? Because it's not something that people get taught, I think, in Econ 101, so to say, in the first economics class in university. And then why did you decide to write this book about it?
Yeah, so what is resilience is actually a very interesting question. So it's essentially bouncing back. You know, once you face a shock, you don't block off the shock, but you bounce back. And I think probably the best way to explain resilience is to contrast it with other concepts like robustness or avoiding risk or sustainability. And perhaps I can say a little bit about, how is it different from robustness? If you're very robust, it means you were hit by a shock and you don't move at all. You just can block off the shock. Resilience means you're hit by a shock, you really face the shock, but then you are agile and modify your response such that you bounce back much more quickly. And one way to contrast this is you go back to a 17th century French writer, La Fontaine, who compared the oak and the reed. So the oak is like very rigid and very strong, and when the wind comes, it doesn't move much, so it's very robust. But the reed is constantly going back and forth, but when it's hit, it will bounce back. So the reed is much more resilient, while the oak is much more robust. But there's a big difference between the two. One is, if you are robust, you might have a robustness barrier or a tipping point. If there's a hurricane, the oak falls over and then doesn't come back, while the reed is always bouncing back. And actually in the story by La Fontaine, there's a fable and they talk to each other. And then the reed talks to the oak. I bend, I bow, but I do not break. So that's, I think, the big difference. And there's some concept which I worked on earlier, which is this volatility paradox, which seems something which is very volatile and constantly moving around seems much weaker than something which is very rigid and stable and doesn't move much. Mm-hmm. But at the end of the day, the reed, even though it seems very volatile and weak, seems much more resilient or much more stable ultimately. And that's what I think a society should be. It should not be very rigid. It should actually allow for people to think differently and move and adjust. It seems weak, but then you bounce back much more quickly, and I think that's one of the big differences.
So is resilient then better than robustness, or is that too simple to say?
It depends. So it depends what risks you face. So if you have resilience, it's typically cheaper to have resilience, because if you want a robust system or a robust society, for each shock you need a lot of redundancies. So it might be even impossible. Think of a skyscraper. If you want to make sure that it is very rigid, it doesn't move in the wind at all, you probably have to put so much resources on it that the skyscraper cannot stand anymore. While a resilient, where the skyscraper moves around in the wind and always bounces back, you may need much fewer resources. So the big difference is, instead of having for each type of shock a redundancy or some extra reserve units or whatever you need fewer, but you need more flexible reserve units which you can move around. So it's cheaper in a sense and the whole system becomes more stable for many more shocks compared to a robust system. And I would say it's better, but of course it depends on the eye of the beholder. If somebody doesn't want to move at all and doesn't want to be agile and flexible at all, then people might prefer robustness.
Right. Yeah. But one interesting thing that I noticed in your explanation is that you don't yet use a lot of economic concepts, and this ties into a question that I have. Like, why do you think that we as economists hardly discuss resilience? It's not really on our radar too much, is it?
The problem is that we just simply assume it. So in most of our models, we have, so I'm going a little bit more technical here, we assume that we live in models which have a stationary distribution. So essentially when there's a shock, you come back automatically. So it's not analyzed, it's just assumed that we will come back. If we will not come back, then we have a degenerated distribution. So you just get a shock and then you can't come back from that. And we typically rule this out. So we essentially by assumption, we said, oh, everything is bouncing back. But I think it's much a deeper concept. So we have to understand, when do you bounce back? How quickly does it take to bounce back, and all these things. And I think there's a rich literature to evolve to study more resilience. And also, people have not studied really the contrast more to robustness.
Right. Yeah, so this is, for example, something that is indeed the case in macroeconomic models, right? Then, they model a macroeconomy and they look at something like GDP, which finds a steady state at some point, but then they study sort of outside shocks, and then the assumption is that the model returns to a steady state.
That's correct.
Right? Yeah.
And if you have a model, it turns out that you would not return to a steady state. You would throw it out of the window. So you would say, oh, that's not a well-specified model.
Right. Oh, yeah. Okay. And so this maybe relates to, this is one of the examples that you use in your book, that what we actually see in many macroeconomies is that we might get hit by a very big crisis, but then we don't return to the steady state that we had before, the growth path. For example, Europe is a very well-known example, right? Like, we were hit by the global financial crisis, we were growing before, and then we sort of permanently grew slower afterwards. Is that true?
Yes, that's true. So in particular, if you have a financial crisis, you see it in the Euro crisis, but you also see it in the US of the global financial crisis, but most strikingly probably in Japan, where you see, whenever there was a financial crisis, then actually the growth rate is going down, and actually level. So the level drops off and the growth rate subsequently is coming back down as well. So you don't go back to the old growth path. And that's very different from shocks, which are exogenous shocks like an earthquake or Fukushima. You bounce back very quickly. So that's very striking in a sense that that financial crises typically make it much harder to bounce back.
Yeah, and you already briefly mentioned it, but there's difference that economists typically make, right? Between shocks, so stuff that affects the system, put very simply, between endogenous shocks and exogenous shocks, where endogenous means coming from within the system, and exogenous means coming from outside of the system. So, for example, in macroeconomics, the example that I typically like to use is an exogenous shock might be, for a macroeconomy like the United States, might have been the oil price shock as a consequence of a war in the Middle East in the 70s. And an endogenous shock was the global financial crisis, which was generated by the American economic system, right?
Yes.
Could you elaborate a little bit on why that's important and how it affects resilience?
Yeah, so that's very well taken. So in a sense that what you have in endogenous shock, the risk is building up beforehand. So there's an imbalance is building up. And then there might be a little shock, like a subprime shock or something, and that erupts then. The system is not coming back to the old because there was some imbalance building up. But on the other hand, if you have an economy which has no imbalances and there's an exogenous shock, you just take the exogenous shock away and then you can bounce back to the old growth path. So it's really the imbalance is building up before the shock, which really make the endogenous shock more dramatic. And it goes in two ways. One is there might be a little shock, but then there's an amplification going on. And there's a lot of literature on amplification. That's the endogenous part of the shock. But then the second component is the persistence. How quickly can you come back? Can you come back essentially to the old growth path? And that's where the resilience concept comes in.
Yeah. And related to this, this was also some of the first things that came to mind when I read your work about it, is there's this concept from Minsky, and that's about financial stability, which basically says financial stability itself is destabilizing. Now, I know that financial stability is a little bit different than resilience, but I could imagine, and I wonder what you think about this, could resilience also be making the society more fragile? Or is that, am I now mixing up the concepts?
No, that's true. So essentially let me put it differently. If you can avoid crisis, and that's like a Minsky moment to reduce instability, if you avoid small crises, it might lead to this buildup of imbalances, which might lead to a larger crisis later on. And so being exposed occasionally to small crises, knowing how to react to small crises, actually helps you to overcome a larger crisis later on as well. So, so calming everything down at any cost, making sure there's nothing, going on in terms of crisis might actually be a bad thing ultimately. So it's a little bit like if you think about the human immune system. If I raise kids in a very sterile environment, then it is probably the case that the kids, when they are hit by a bacteria or some virus later on, they will be really hit very hard. But if they are raised in a less sterile environment, then they have a little bit sickness, a runny nose here and there. But then when there's a virus more severely coming, they have some immune system is built up. And this way, the same thing, the society should be exposed to smaller shocks here and there, should learn how to react to shocks. And then when there's a bigger shock, they'll have a better ability to cope with the bigger shock as well. And that's one element. And the other element is that there's this build-up of imbalances. If you don't have a shock, the imbalances build up further and further. And that comes to in play. And that's, you can relate it actually to Minsky's concept and saying that stability breeds instability. So if you don't have a crisis, it makes it much more difficult to deal with a crisis down the road. Here, what I would argue is that also much more difficult to bounce back. So it's on top, there's this amplification going on, a much more dramatic amplification, and it takes also longer to come back.
Right. Yeah. Okay. I think that's clear, and it's definitely an interesting concept. But that gets me to like why now? Why did you write a book about resilience now?
So as I said, I worked on systemic risk before. So it's like, the banking system or the financial system, how can we measure systemic risk? I developed this systemic risk measure, COVAR, which is the value at risk. But so typically the way we measure risk was all how risky is this particular bank. But we never really measured how risky is that some bank goes under and then it will drag another bank down. Okay, so there's a difference between the risk of an institution in isolation and the risk of a bank going down, dragging another bank down, the spillover effect. So we had to develop some risk measures focusing on the spillover risks, and that's, I think. And then coming back to this volatility paradox, you realize very quickly that, being in a world where you put it seems very strong, very stable, very rigid, then the system seems very stable, but it's actually underneath, it's not stable at all. And that's where the flexibility comes in, and so arguing for more flexibilities. And why now? I think it was the case that when COVID started in March 2020, I started a webinar series inviting some key thinkers to, economists, historians, and policymakers as well, to help us to get through this period and figure out what to do. And it's still ongoing. And the initial motivation of this book was essentially to summarize all the insights I gained from this webinar series. But then I thought, there's no common thread in this summary. So then I thought about how can I make a common thread, red line going through the whole book. And then the resilience concept was essentially the one coming back to, bringing all of this under the same roof, essentially, of resilience.
Yeah, and you also related a lot to this massive crisis that we've seen. I'm not sure if I can yet say that we have seen it in the past tense, but that is COVID, of course, right?
Yes.
And I was wondering, is this also another example that we're just now starting to see, where China and Western societies have a very different approach? And perhaps you could say that China had more of a robustness approach, which seemed more successful at the start, but just now, the city of Shenzhen has gone back into full lockdown because perhaps it wasn't resilient enough.
Resilient, yes. So very much so. So there are two aspects. So it's in resilience, you always want to have a crisis containment element, and you also want to have a bounce back element. So there's two elements. If you go for resilience, the second element is very, very important. And the COVID crisis, essentially, is bouncing back was to develop some good vaccines. So that was one key element for the bouncing back. Mm-hmm. And the West was focusing very much on this new technology, mRNA vaccines, and that actually was a big component of the resilience effort. You didn't see that in China. So generally, I would put out a conjecture, essentially, that democratic societies, open societies, which allow discourse and all this, seem much more volatile and seem weaker. It's a little bit like the reed. While more authoritarian societies seem much more robust. But then there is at some point a robustness barrier. You break through, and then suddenly you have regime change, and you have one dictator is replaced by another dictator. While democratic society transition is much more smooth. And there's a hypothesis there. So I didn't spell it out explicitly. I make it more as like a hypothesis because, you also see some democracies going south. The Weimar Republic in Germany between the two world wars went south too. So it's not, 100% foolproof thing. But in general, I would say if you have an open society, the information flow goes from the bottom up, and this actually helps it seems much weaker because there's constantly controversies and debates and all this. But at the end, it might be more resilient compared to a society which is very, very rigid.
So this topic is extremely topical at the moment, I think, right? But and I have to resist every urge to start talking about it more. I will ask you about this more, but I think this is a great bridge to ask the people who are watching now live, because what we have done now is really try to discuss the concept of resilience, but it is, I would argue, since economists don't use it that much, it is a fairly tricky concept, perhaps. So I think this is a good moment to maybe ask people in the audience if they have some questions for Markus, and have a look at that. And then after that, I have a lot of burning questions about the differences between democracy and authoritarian societies, also in light of what we are seeing now playing out. So shall we do that, Markus?
Yep, sounds good to me.
You can also see the chat, right? I'll also have a look.
No, actually, it didn't work at the end.
Oh, okay, it didn't work. Okay, then I will have a look at the comments. Let me see. Someone is saying, money managers do not value resilience, maximum profit, cut costs now. Tomorrow is another problem. The short-mindedness is what drives bonuses. Okay, yeah, that's a good point. So can you maybe comment a little bit on that? So money managers and resilience, or perhaps financial markets in general and resilience.
Yeah, so that actually leads me to another point. Perhaps when we go to money managers, what's the difference between resilience and avoiding risk? Because money managers try to avoid risk, and they also try to avoid drawdowns. When you make a lot of profit, if you go down from a high profit period, you go down, make a lot of losses. So what's the difference between risk and resilience? Risk is essentially a standard deviation concept. It's a static concept, while resilience is a dynamic concept. It's over time. You have a shock and then you bounce back. So you measure it in terms of mean reversion or half-life of a shock and things like that. While risk you would measure as variance or standard deviation or something like that. And typically, when you want to avoid risk, or let me put it differently, I would like to push a shift in mindset where our societies, especially in Europe, are very more focused on avoiding risk. And I would argue that not every risk is the same. There's risk which comes with resilience, and these risks are not dangerous. And actually, we should take this type of risk. So if we do trial and error and we experiment with new things, but as long as we know we can bounce back from that, then actually is not a big deal. So actually, we can have some setbacks. As long as we bounce back, we should take risks along these lines. But there's some other risks where what they're called is a resilience destroyer. So if there's a shock and we cannot bounce back, these type of risk we should avoid. So rather than saying, oh, we want to avoid risk at any cost, we should say, let's avoid the risk without resilience, and the risk which come with resilience but help us to experiment and try out new things, we should actually take. So what are these resilience destroyers? The resilience destroyers are traps, for example, middle income trap, liquidity trap. Economics has a lot of these traps. So in a sense, there is already some literature there in economics about resilience if you think about all the traps we have studied.
So can I just quickly clarify, because these are already quite a few terms. Just for your example, the middle income trap is where a country, like for example Mexico, had high growth, but then it got stuck in what they call like a middle income country level, and where there were expectations that it would join the advanced economy, so to say. It got stuck there, and this is a bit of a conundrum and related to what you read about in the book, right? And what was a liquidity trap again?
So typically there's this phenomenon that the emerging economies should catch up with the advanced economies, but that catch up initially, and then at some point they're in the middle income trap and they can't really go to the frontier. And the explanation is often that the economy or the social setup you need in order to do frontier research is very different from the economy you need to just to copy and catch up. And that's why you get caught in the middle income trap. The alternative is like a poverty trap, where poor people just face a negative shock and then they can't come back. And it's another form of trap. And there are many, many traps. So that's one resilience killer. So traps are resilience killers. And then there are also feedbacks. They're even worse than traps. So once you're hit by a shock, there's a feedback loop and makes things worse and worse. So these are liquidity, there's some spirals or feedbacks. And typically they're hit when you hit a tipping point. And they're in society, but they're also in environmental or in general in any system. If the Gulf Stream were to stop, then you can't make the Gulf Stream start again. So I moved a little bit away now from the money manager. Yeah. But so essentially we should now come back to the money manager. So the money manager should actually not say, oh, I want to minimize my risk. I would like to minimize the risk associated with non-resilience. So if there's a risk from which I cannot bounce back, I should really avoid that. I have to, but other risks which are temporary risk and I can bounce back from by re-optimizing my portfolio or readjusting my portfolio, whatever he wants to do. So we have to have a shift away from a risk management to resilience management approach. And I think that's a broader message of the book I wanted to get across, that in the financial sector, but mostly in our societies, in many of our societies, we are too afraid of taking on any risks. We should actually take certain risks if they come with resilience, and they give other benefits. This trial and error approach and other things. We're trying out new technologies, openness to new approaches. As long as they come with resilience and we can manage it and we improve our resilience attitude, how agile we can react to that, we should actually take on more risks, because that's how progress happens. Yeah. And if I go back to the environment, sometimes it might be the only way to avoid some tipping points. So it could be that in environment, if we don't take on any risk and we just continue as we're going actually down the drain. So we have to experiment with new technologies, innovations in environmental space in order to get out of the current situation.
So just if I can maybe think of an example with that when it comes to money managers, and then you can say if that's a correct example or not. Yeah. But for example, so maybe some money managers want to invest in economies, in macroeconomies. I'm taking this example because that's the stuff I'm interested in. But let's say like in 1997, you had the Asian financial crisis. And around that period, there was a lot of volatility. But an economy like South Korea turned out to be highly resilient. right? Whereas some economies like perhaps Indonesia, I think at the time, proved to be far less resilient. But they were both at the time equally risky if you take that sort of finance way of measuring risk, which is a standard deviation of the price. Is that a good example?
That's a very good example. So, and it often depends on the policies you take after a shock, whether you can bounce back more easily or not. And from an ex-ante perspective, if you know that a certain economy will take certain policies to bounce back more easily, then as a global hedge fund manager, for example, you have to take this into account when you make your investments. So it's not only about the current risk, how risky is Indonesia versus South Korea, but what is the political framework to allow the political framework to take certain measures to bounce back more easily. And that's what should be a big input in your portfolio choice.
Hey, I have another question from the chat, from Louis Petitjean. What does too much resilience look like?
So too much resilience means there's a term structure of resilience. So essentially, bouncing back too quickly can mean that you have used up all the reserves, and if you make you more vulnerable to a second shock later on. So, for example, if you have a shock and the government goes there and uses all its fiscal space to bounce back very quickly, and then it's very vulnerable to another financial shock subsequently. In this sense, it's not too much resilience in a sense you bounce back, but you have actually sacrificed future resilience in favor of current resilience. So there's a dynamic trade-off one has to consider. I think that's probably what I would argue. It would be too much resilience, just bounce back, or it also means sometimes coming back to kicking the can down the road. If you say, I bounce back right away, and people don't really know how to react to a crisis because the crisis never comes. So the small crises are avoided at any cost all the time. So you bounce back right away. But then actually down the road, people don't know if there's really a big shock, how to react to that. That's another argument why there might be too much resilience. But in general, resilience is not a bad thing. So it's hard to get too much of resilience.
Okay. And then one final question about this, and then I think we shall move on to some more examples and get a little bit deeper. WMD asks, are there any books, Markus, that you would recommend to learn more about this topic? And I assume that he means apart from your own book, which you should all read, by the way.
So thanks. So there are not so many economic books I'm aware of. So what one can read is papers. So I cite in the book a lot of papers, I think. And for example, the OECD also ranks countries based on resilience. So the OECD did actually in their work, they did some work, some studies. It's mostly focused on economic resilience, less on society, because social cohesion and elements like this matter a lot for resilience as well. If you have a society which is very divided, you cannot move, so you're not resilient in it because you can't react to shocks. While another society which is much more socially connected to each other, it can move and adjust much more quickly, and hence avoid being in a trap and things like that. But I would say there's a lot of resilience analysis for individuals in the psychological literature. I should say a little bit, historically, the resilience concept comes more from material science. You look at certain material, then the material is shocked. And the question is, when the shock goes away, will it bounce back to its original state or not? So there's some work on that. And then there's also work a lot about individual resilience. So resilience comes at different levels. It comes at the individual level, it comes at the system level, and also in the societal level. And for individual resilience, there's a lot of literature from the psychological experts saying, look, how can you make yourself more resilient? And of course, if individuals in a society are more resilient, then the whole society is more resilient, but the society is more complex because the whole interactions are not captured by the individual resilience. And so there are hundreds of books, but I'm not really an expert on this. I'm more on the societal or economic resilience. And I cite several of these books, and I also cite at the end notes some of these papers. But I can't point to a particular paper and say this would be the ideal paper. One source would be the OECD to check out their website and their effort of studying resilience.
Yeah, I will do that as well. Actually, I didn't know that the OECD had a resilience indicator for countries. And I do think what you mentioned ties into a broader tip. I think about, when you're learning to dive into topics yourself, learning to dive into literature, a great and fun strategy is to read a book. Start with a book that is very broad. And then, as you mentioned, go to the appendix, go to the references and see what sources they use. And that's a great way to get deeper into the subject matter. But that being said, in the questions, actually, I wanted to move to the geopolitical situation today, and we will. But you made me realize when you were answering one of the questions from the audience, there are some parts of resilience that we have that I would like to talk to you about first, because I think it gives a deeper insight into this concept, and it's also something that the book really did for me. Because I was aware of the concept of resilience, because it's also featured in complexity science quite a bit. But what I had not yet really encountered is sort of practical advice as to how to make a society more resilient, especially from the economic angle. And you already mentioned a little bit like the traps are an important part of that. Of avoiding traps is how you make your society more resilient. But there are some other ways. I think you made some categories as to how to make a society more resilient, right?
Yeah, so there are different aspects to it. So one aspect is, of course, in order to understand when a society is not resilient, it is often due to externalities combined with feedback loops. And in economics, we call this strategic complementarity. So it's like, if I do something, I cause a negative externality on you, Yuri, but then you react to that. And your reaction is like a strategic, you react the same way. And your reaction then causes spillback on me, and I will then do even more and I react to your spillback. And this we get in a feedback loop. So it's only with two of us, we already in this feedback loop. And then the situation is already worse than before. And we spiral essentially out of control. And the society should have a social contract to maintain this feedback externality. So externalities are already bad. We know this from standard economics. But if they're combined with the strategic complementarities, then they're really bad, because you get in a whole loop scenario. And a big chunk of our social contract is essentially to avoid that. So I'll give you a very trivial example. It's like hoarding toilet paper.
Yeah.
I buy some toilet paper, then there's less toilet paper for you. Then is Markus is hoarding toilet paper. You might hoard too. Then I have to hoard even more because Yuri is buying otherwise everything. And that's at the end of the day, people who really need the toilet paper, they don't have it because it's all hoarded by very few people. And that's just a trivial example, but we have such examples all over the place in the economy. And so we need some design in order to contain these risks of these feedback externalities. And that's one thing. And then the question is, and that's not so in the book, but I'm thinking along this line, so how does it relate to a society which is designed from the top down versus a society which is like a Hayekian spontaneous order from the bottom up? So which society is more resilient in a sense? So you can have a society, there's a central planner who is like what we typically do in economics. We say, there's a mechanism design problem, and we design everything optimally and I do this from the top down, so a social planner designing things. Or is it more like a society where things evolve like languages? No, nobody has designed our languages. That's Hayek's favorite example. Then in that case, what is more resilient? And my hunch is that actually a society the elements come from the bottom up is more resilient, because you went through evolution through many, many shocks, and things are not so symmetric. They are a little bit chaotic and complex. And sometimes this can make actually a system which is less symmetric, less homogeneous, more resilient, because it just reacts in different ways.
Yeah.
So that's one thing. But more generally, how to manage and create resilience, I would say there are two aspects to it. One is to control these feedback loops and externalities. And the other thing is to have a second strategy to bounce back. So you have to have this two-pronged strategy. in maintaining and containing the shock itself, and at the same time develop a long-run strategy to bounce back to the new normal, whatever the new normal might be.
Yeah.
And that's the element. And communication is very important in that element. And there's some additional challenges, if I jumped into that, about the communication. So put yourself, during the COVID crisis was very difficult because you learn on the spot what's going on, how the virus reacts for a policymaker, and you have to design policy and then make decisions very quickly, not knowing in the fog of war essentially what to do. And at the same time, you have to communicate to people, and people typically have a hard time to understand counterfactuals. So for example, if you do a lockdown and you see the number of dead people is not really going up dramatically compared to previous years. So that's, for example, in Germany, when you saw 2020, only in the fall, actually, dramatic increase of the number of deaths.
Mm-hmm.
But before that, it was not extraordinary. Then people say, oh, this, why? There's no problem. I cannot see a problem. But the reason why there was no increase of the number of deaths was essentially because there was a lockdown. But it's very hard to communicate a strategy saying, okay, we do a lockdown, we do everything what we can do, and then you don't see the effect, but you don't see the counterfactual. What would have happened if you would not have done a lockdown and the number of deaths would have skyrocketed? And that makes it more challenging. And paradoxically, a resilient strategy, or if you go for robustness, that's what you do. You make a lockdown, you block everything, and it's very hard to communicate. Yeah. If you go for a resilient strategy, the shock hits you first. So it actually makes it easier to communicate to the public.
Right.
Like, oh, look, we are hit. We have to do something, and we have to react to that. So a resilient strategy has, in a sense, an easier way to be communicated to people who have a harder time to understand counterfactuals.
So I think we saw that a little bit in Australia, perhaps, right? Where they were very successful at containment, at blocking COVID infections. Australia, for a Western country, did insanely well in that respect. But then they had a very low vaccine uptake compared to countries like in Europe that were very hard hit.
Yeah, you also see it within Europe, like Italy's vaccine uptake was way higher because they were hit early on very hard. Mm-hmm. That's because it's a very good example because you don't see essentially what the problem is.
Yeah, so if I could just try to summarize that a little bit, like because the people who are watching are a lot of them are interested in economics and perhaps interested in a sense in designing a society, and so if you want to make your society more resilient, the first aspect you mentioned is to you have these feedback loops. They are very they are resilience killers is what you called them. I think they potentially are. So, for example, in a stock market, you can have herding behavior where there's a run on stocks, a run on equity markets or something, or maybe a bank run is even a better example. And then one way to contain that is to close the banks for 2 days. That's something they often do, and that doesn't always work, but it still seems to work actually sometimes. So that's. If you build that into society for all different kinds of problems, you would have a more resilient society.
That's correct. So it's like in the stock market, circuit breakers or bank holidays, as you say. These are essentially elements where you put in. These are small little things which can, make sure that the feedback loop is not the whole thing is not spiraling out of control. Yeah. It stops it. Then you also need something to come back, essentially. So you have a circuit breaker active, and then you also call people up and said, look, there's actually a cheap buying opportunity. Can you support the market? So the circuit breakers do two things. They stop the current trading, but then also there's a lot of activity going on to bring potential buyers in who haven't noticed the price went down so much.
Right.
That's where the bounce back comes in.
Right. Okay. So let's say you have a catastrophic market collapse. Could you say that then, for example, QE might be used as a bounce back mechanism, the way it was first used, not the way it's used now to keep on trying to lower inflation, but I think originally in the US it was as a way of bouncing back, right?
Yeah, so if you look at March 2020, essentially we had a potential catastrophic decline of the US Treasury. Typically the US Treasury is the safe haven where everybody is rushing into. But everybody wanted to get in March of 2020, the international investors wanted to get out of the US Treasury, wanted to get US reserves.
Yeah.
And the Fed intervened very, very heavily as a so-called market maker of last resort, trying to essentially buy a lot of US Treasuries and issuing US reserves. And that was one way to stabilize the whole situation. Without that, the situation would have spiraled totally out of control. So being a lender of last resort, or international lender of last resort, market maker of last resort, all of these tools, essentially, to a large extent, crisis containment tools, but you can also think and expand on them to be resilience tools as well by, emphasizing more the bounce back element.
Yeah, I'm happy you mentioned this example, because I think it's often used in a financial stability way, but it's also something, I even got burned by that a little bit. Like at the start of COVID, I had US Treasuries and I thought, oh, okay, well, maybe we'll see the same thing as at the start of the global financial crisis. But then US Treasuries tanked, and later I found out that that was because of a dash to cash. So they went for even safer assets. And policymakers actually stepped in very rapidly, having learned, I guess, like having become more resilient because of the experience of the global financial crisis, right?
Yeah, so the reaction time was way faster during the COVID time compared to the global financial, because you could just undust your old toolbox and just employ it again. And that was actually very decisive action in the early phase of the crisis, which helped the whole global financial system. Otherwise, it would have gone way, way more dramatically wrong.
Yeah, I actually have another question about this. Since we are still talking about financial markets, which is something you're very good at. So I just mentioned to you before the start of this interview that I really enjoy this paper that you've written about the global financial crisis, because it's in the Journal of what was it again? Economic Perspectives.
Economic Perspectives.
Yes. Yeah, which is sort of a chronicling, or like really describing in detail from day to day what happened during this massive meltdown of financial markets, basically. So it's really like, then this bank fell, and then that had these consequences, and that bank fell. Now, so people, please read that. That's a great paper. But my question is, do you think that financial markets today are still fragile, also compared to back then, but perhaps they can also be fragile in a different way? What do you think about the state of financial markets?
So I think the financial markets are fairly self-stabilizing for small and interim shocks, but for large shocks, they are not they're very fragile and they fall out of control. And that's when the government intervention is actually necessary. So people always think markets are, stabilizing themselves and all this, but I think it's only for small shocks. So for small shocks, you're shocked, and then people see this as a buying opportunity, then they push the price back up and everything is stabilized. But for large shocks, the system is not stable and it's very fragile. And for that, it's actually necessary that the government, which has additional taxing power and commitment power going way further into the future, is actually needed to stabilize the financial system. And of course, that itself creates problems. If then whenever there's a large shock, the government is bailing them out.
Yeah.
Or is creating a Fed put or whatever, that creates instability on its instability. That's a very delicate balance on the one hand, you want to make sure that the system maintains its functioning. On the other hand, you don't want people anticipating that, and that makes actually then the system unstable on its own.
Yeah, because someone in the chat also mentioned that debt is back at super high levels, both in the private and in the public sector,
yes.
Right? And then we have seen exactly that financial markets get bailed out and QE continues. So I think a lot of people are afraid that financial markets are again, not just fragile as they always are, which you say, which I agree with you, but more fragile than they always are.
That's correct. So essentially, one measure is the level of debt, and that's, as the audience member points out, we have very extreme high debt levels on the public sector, the private sector, and that makes the resilient space much smaller. So the feedback loops kick in much earlier, much more quickly. That's essentially is makes the whole thing more fragile, and also then would ask for the public sector to come in. But at some point, if the public debt level is so high, then actually the official sector don't have the capacity anymore to bail out, to bail out or to stabilize the system.
Yeah. So hey, this brings me to a subject that I think is super relevant at the moment for resilience that I would love to discuss with you, and that is I've seen more and more people talk about. Also, my previous guest Isabella Kaminska, who used to be at the Financial Times Alphaville blog, mentioned that it looks more and more that we are on the verge of a sort of big paradigm shift, both geopolitically and perhaps also economically speaking. What do you think about that?
Yeah, I think we're in a paradigm shift. That's correct. So it's if you look at the global system, it was actually built on two ideas. One was to generate interdependencies. So we are dependent on the others are dependent on us, and that actually makes war less likely. And the other idea was what in German is called a Wandel durch Handel. So you by trading, you interact with people and makes it less likely. Then you change people's attitudes, and actually you change the people as well, and you change the governance structure as well in the long run. So openness, trade, and creating mutual interdependencies was actually the key. And you can see also global value chains this way. If you have we really depend that the other country is delivering all the goods. If they don't deliver, we will be in trouble. If we don't deliver to them, they will be in trouble. So nobody wants to have a shock. Okay, there could be an outside shock like COVID, which hits all of us, and then we're in trouble. And that's why we talked a lot about resilience. But now if you move to a much more resilient society or resilient societies, it could also mean we move much more into autarky relationships, and so we get rid of these interdependencies. Hence, the force which prevents us from attacking each other is actually also reduced, because by attacking each other, it doesn't need to necessarily be a war, but attacking each other economically or saying, okay, I cut you off because of this. If it's less costly for me, imposing sanctions on others is probably also more likely. So the whole globalization movement might go backwards, and that might hit the emerging economies in particularly hard, because they rely on having open global markets. And there are essentially two ways to go. One is to say, okay, everybody's so-called this reshoring, we're going back to autarky, and that's one way to create more resilience, that you bring all the production capacities back. Or you can also go more the multi-sourcing approach, where we're still interdependent, but less interdependent on a single country necessarily. So I, as a company, I source from 3 different continents. So if there's a shock in one continent, I still have 2 other continents, and I can be bailed. Of course, there's less interdependencies already. So if a government says we shut out one country, I can just switch to the other 2 continents suppliers, and everything will be fine. So you can see that the use of sanctions will be much less costly, and hence might be much more frequent from both sides. And that might undermine the whole, globalization movement. So, and it probably went into a watershed moment also with the war now in Ukraine, that people want more resilience, and they probably want to also more autarky, and that also makes it more likely to have more of these events coming as well. The sanctions frequency going up on both sides, on several sides, and that might divide the world much more significantly. So resilience, as an earlier audience member said, is there too much resilience? So if you have a lot of resilience, you also feel free to impose sanctions much more frequently. And this can be on both sides. So if both sides do it, that's also counterproductive.
Yeah, I think this is very interesting, because it does actually relates to what Russia was doing. So as you mentioned, countries seem now to be moving more towards resilience, which, hey, great, they might have read your book, right? So economically speaking, it makes sense to be less reliant on Western finance, if I'm talking from Russia's perspective, for example. But as you mentioned, Russia has been doing this since 2014 very deliberately. They've also tried to move their reserves from dollars to euros. But that might have actually emboldened them to take this geopolitical step and invade Ukraine, which might then have reduced resilience from the war or geopolitical perspective. So increased economic resilience leads to less geopolitical resilience.
So what we want, essentially, we want to have a global economy where the whole globe is more resilient to outside shocks like COVID, but each country might not necessarily be extremely resilient, because that creates the possibility of starting wars or imposing sanctions much more easily. So there's global resilience is, I would say, is always good, but country-specific resilience might lead to behavior which might undermine overall resilience from a global perspective.
Yeah. That's definitely an interesting point. I hadn't thought of it like that before this conversation. And it does make me wonder, maybe it ties into, because this is also just briefly mentioned in your book, the role of the US dollar. So I've been discussing with many money and macro viewers, like, hey, maybe, these sanctions, the way they have been applied now is fairly unprecedented. Not that a lot of them haven't been done before, but more the scale at which they have been applied and the speed at which they have been applied. But that does give many more countries, especially a country like China, a very powerful incentive, like, hey, maybe I don't want to rely so much on US dollars. And I thought euros were perhaps a good alternative, but the Russian experience has shown that these can also then be frozen fairly quickly. But then again, there isn't much of a dollar alternative. So how do you think, is the dollar still resilient? Is maybe what I'm trying to ask.
Yes. So I would say that two aspects to it. One is, if you have this tool of imposing sanctions, and if you have a certain value system and you want to preserve the value system, for example, nobody should invade another country, you probably have to use the sanctions occasionally. If you never use it, then the sanctions are useless too. If it's just threatened all the time, but you can't use it. But this was, I think, a case where you have to use it wisely. But it is definitely the case that the dollar is a very powerful tool, but I also agree with you that there's no real alternative. So it will be hard for China to build up very quickly an alternative, as long as there's no open current account. So you cannot, there's no capital. With capital controls, it's very hard to generate some alternative in this space very quickly. And the dollar is so big, the dollar market is so big, and it's not only the US Treasury. We issued another 10, 15 trillion of US Treasury in the last decades. So it's a huge market. And, if you go to Peru, the banks are issuing US dollar denominated deposits. So it's not only issued by the government, but there's a whole banking system which is really rich and very, very vast in this market. So pushing this off into shifting to another equilibrium essentially is not easy. So we have this dollar equilibrium we are in at the moment. And if you want to move from this equilibrium and coordinate to another equilibrium, if you use econ language here, you have to change a lot of high order beliefs. There has to be a catalytic event to really shift that. And I don't see that coming up in the near future. Of course, there are the new elements like cryptos and other things. But if you look at crypto, of course, there's Bitcoin, but most of the stable coins, 90% are stable coins towards the dollar. They're also tied to the dollar. So the dollar is still at the anchor and the core of the system. So I don't see this going away very quickly.
But if I'm sticking in your terminology of resilience, if we move away from it, it could be sort of a tipping point situation where it might be extremely painful.
Yes. So we also shifted at some point from the British pound to the dollar. So it is not typically the case that it will be a more gradual shift. So I don't think it will be one radical day and say, no, now everything is shifting. So it will be a more gradual shift, but it will be a loss of power for the Western world. So if you think of a world where everything is more guided by the US dollar and the euro combined, shifting to another that would be a big loss to the Western world.
Yeah, for sure. So let me just ask you one last of my questions, and then maybe we can still take a couple from the audience. Because what you were also talking about is also very relevant in light of what we're seeing today with the war in Ukraine. And that is, you were saying, or you were, I guess, speculating that a bottom-up society, so more democratic societies, are perhaps typically more resilient because and they appear weaker because you see all this discourse, left wing against right wing, see this outward heavy volatility, you could say. But this is actually the thing that makes them less likely to collapse. And you very often see rather stable dictator or more authoritarian societies, like even the Soviet Union. I'm doing some research for a video on the history of the economy of Russia. And while doing that, I came across these Margaret Thatcher videos stating rather confidently, a very right-wing politician, how the Soviet economy was on the right track and, was going to be just fine. And then, related to that, I'm now reading more about, hey, maybe we might see another, or what we're seeing now is another battle, so to say, between democratic ideas, more decentralized ideas, and more authoritarian philosophy, represented in this case by a sort of axis of China and Russia. What's your view on how that relates to resilience, and perhaps also, that's it.
So here I would say. You put it very nicely. So in terms of resilience, as long as democratic and open societies talk to each other and information flow is there, I think it's more resilient. It seems, there's a discourse going on and all this. But of course, if you go to the more extreme where they're just talking past to each other, then the fact that you also lose your social cohesion in a sense, and then you become less resilient. So what's really important is that you stay. And that's why I think where the Weimar Republic comes in. So once the society becomes so extreme polarized, where you just talk past each other and you can't really have a discourse. And I think for resilience, what's really important is that you have a discourse, you have different opinions coming to forefront, but you still try to understand the other side and try to take in and make a counter argument. And that's one, I think that's a very resilient society. If you move to a democracy where people just talk past each other, and everybody lives its own bubble, and they don't talk to each other anymore, don't try to convince each other anymore because they just think the other side is stupid or whatever. They live in a different universe. And that's where social media has, created such an environment, or the whole polarization created this environment, and that makes actually the societies less resilient. So I would argue that if I compare some European countries with the US, the latter, the social cohesion is less pronounced in the US, and that's where also what hurts resilience. So if you look at the economic resilience of the US in terms of flexibility, agility, and the OECD ranking, US is more resilient because it is just more flexible and adjusting to shocks and all that. But if you take the social cohesion aspect, so people talking to each other and not just dismissing each other, that's where many European countries are much more strong. And that's essentially what, and paradoxically, Putin's attack on Ukraine has actually brought, also different factions in the US closer together again.
Yeah.
And hopefully brings, smoothes over this. So what we need is essentially an open society. For a resilient society, it has to be very open, and it has to be, a discourse has to be going on. So the difference in opinion has to be exchanged, and there has to be a debate rather than living in different separated bubbles. And so I would say that's what would be the optimal answer. And autocratic societies, of course, suffer from the fact that the information flow is not there. You don't dare to say, I can imagine that, in Russia's, it's very hard to say to the leaders, saying, okay, I think this is the wrong decision because of this and this and this, and you don't see the information program. And that's typically for dictators, it's the case that, the information flow is not coming up, and so you only get yes men at the end of the day.
Yeah, Yeah, and I see your point that democracies can also, be not be resilient, where the Weimar Republic is a good example, and where people are more and more worried about how fractured socially the United States seems to be at the moment. Yeah, let's see what happens there. It's definitely very very interesting time. For resilience in general, and I hope we're going to be resilient. But with that being said, let's have a look at what the audience is saying. Do you have time for a couple of questions from them?
Yes.
Okay, excellent. So I will have a look at what people have been saying. So Louis Petitjean says, this economic resilience sounds a lot like the resilience one talks about with biodiversity. Decentralized organization and many independent actors let you bounce back. Is that fair?
Yes, it's a very good point. So actually in the book, if you think about diversity versus homogeneity, and if you think about the social contract, you can bounce back more easily if you have a social contract where one of us suffers a shock and the others one does not, and we help each other. So it's like a social insurance contract. But difference to insurance is that rather than just giving you money, I help you to bounce back by reskilling you. So rather than giving you unemployment money, I give you this reskilling tool. So I send you back to school or do something and in order to find a new job in a new industry and some things like that. So now coming back to, if you have a very diverse society, if there's a shock coming from outside, it will hit us differently. If you have a very homogeneous society, if there's a shock coming from outside, it all hits us the same way. So we cannot really insure each other if you're very homogeneous. And that's a challenge. So all the shocks are less, in econ language, less idiosyncratic. They're much more systematic shocks. And then we can't insure each other. If you're a diverse society, the shocks are more idiosyncratic, so we can insure each other. So on the one hand, we would like to have diversity or biodiversity in order to make a society more resilient. But we also, on the other hand, we know from the work, and that's where the biodiversity analogy fails, by work for Alberto Alesina and others, that the willingness of the people to insure each other and help each other in times of crisis is much less if there's a huge diverse society. If there's a more homogeneous society, actually the people are much more willing to help each other. So the ability to help each other is much bigger in a very diverse society, but the willingness is much bigger in a homogeneous society. And that's where the tension comes in. So you want to have an optimal mix, essentially. You want to have a diverse, open-minded society in order to be able to help each other, because the shocks are hitting each other differently. But you also want to have enough homogeneity in order to make sure that people think they're part of the same group and they want to help each other. And that's what the tension is.
So this I can actually really make a nice bridge to the next question by the Brandon, or maybe it's a comment, who says, I understand of democratics being more resilient, but living in Brazil, a democratic with a big economy, but being in a negative feedback for a decade, my heart can't believe in this. So this relates very much to what you were saying, right? Like Brazil is famously a very heterogeneous society in the sense that there's lots of different types of people in Brazil from different types of backgrounds. It's a democracy, but not the first society that comes to mind when we think about resilience.
Yes, so I very much agree with that too. But
hey, this makes me wonder. So maybe we can relate this to one of my favorite books, which is by Darren Acemoglu and Professor Robinson. It's called The Narrow Corridor. And they go into what makes a society, they don't call it resilience, but they attach importance to inequality, and then especially the elite versus sort of the people kind of dynamic. And that's how they explain sort of the Weimar debacle or collapse, where they said, this was of course a democracy in name, but it was still a very dysfunctional society that is dominated by a small elite. No, it wasn't not necessarily. obviously a dictatorship, but very similar to it because they had so much power. What do you think of that? And I think that could also be related to Brazil and in lesser extent now to the US, right?
Yeah, so it was dominated by the elites. Of course, it was in the transition phase. So you won't move out from a very much a monarchy and into a democracy. So is of course always a learning period. But I think what was the biggest threat for the Weimar Republic was essentially that this was a very multipolar society, and essentially each group had its own. I wouldn't call them police, but its own enforcers, and they were fighting street fights and even with weapons. And if you have the communists on the one side and the Nazis on the other side, and everybody's trying to enforce their way of thinking with weapons, that it's very hard to establish a democracy. And there was no common ground they could find together and make a coherent argument with each other, and that because it was just too polarized. Of course, the elite played an important role too, but even the non-elite was very, very divided. So both of it actually made it much more difficult. I'm not too much of an expert of Brazil to say, okay, I don't think Brazil is in that stage, but I'm not an expert to judge about the society in Brazil. The other thing is, of course, inequality. That's the second part of your question, I would say. Inequality is contributing to that, but it depends very much what inequality is used for. So if you think inequality, there are some wealthy people just using their wealth and splurging it away, or they're actually investing in something productive. Now, if there is no inequality, we probably have way less investment in R&D and new technologies. And so if you have some wealthy people really pushing the frontier in investment and our knowledge, I think that's a good thing to have, as if we wouldn't have these investments otherwise. So if, for example, Elon Musk is innovating new electric cars, I think that's what brought us forward, probably brought us forward 10 years ahead compared to not having electric cars. We might still drive mostly diesel cars otherwise.
I think that's an interesting example that you mentioned, because I've been thinking a little bit about it myself as well, because sort of inequality, equality, it's something where typically sort of the consensus position is, okay, you don't want too much inequality, but a little bit of inequality is good because it keeps people motivated. But this aspect, I've also been wondering about it because we often, as Europeans, maybe ask ourselves, why is there less innovation typically on the European continent than in, for example, the United States? And it might actually be that some of these billionaires, although I think a lot of them make very silly investments, a couple of them at least also do make very daring investments. That's what you were referring to, right?
Exactly. So, the question is, why did some Elon Musk move to the US and not to Europe?
Yeah.
The societies are different structured. So who is more inviting to invite these type of entrepreneurs to push the frontier, essentially, in technology?
Yeah, that and the same goes for you in a way, right? You are one of Europe's top professors, we could say, and you moved to the United States as well. Why is that actually?
I mean, there is, of course, a certain concentration, so there are high synergies if you're in a department with other great economists, so you enjoy being with your colleagues and you gain from their knowledge. And that's, I think, the driving force. And it was not, so US benefited tremendously when the Nazis kicked out all the Jews from Germany. So that's essentially what really lifted the US universities tremendously in the 1930s. And that's, we still see this going on at the moment. And the benefits from that time is still, we still have the benefits now. And that's, I think, playing on that is a big advantage to bring, people together who have similar interests or want to push things in a similar direction. But on the other hand, if you just look at economics, I would say that Europe has made huge strides compared in the last 20 years. It's huge improvements. So the distance is not as large anymore as it was 20 years ago.
That's definitely good to hear. So I think we're pretty much through. Do you want to have some closing remarks on the topic of resilience? One thing already though that I need to mention before you do that, I already saw some comments of enthusiastic people wanting me to tell you that they already ordered your book online during the session.
Okay, fantastic. Yeah, I think if you're an economist or if you're even anybody, you should think about resilience. I think it's an exciting concept, and there's not so much done yet. I think it's an open area where new thinking would be helpful. So I would encourage all of you to think further and even talk about it during dinner parties and perhaps write papers in this space. I think there's a lot of things to be done, and I'm hopeful that people will pick it up more. I think it's a concept which is very important, and I know of some people who already started working in that space, and I hope this will shift and let's make our global economy or global society more resilient ultimately, which is beneficial to everybody.
How can you actually research this then? Because typically as an economist, I happen to know that you either need to write good empirical papers or you need to model using equilibrium models, basically. Can you do that? But either if you want to study resilience?
Yeah, I just give you one example I'm thinking about right now. So in the book I describe, we talk a lot about income inequality or wealth inequality. And I describe this new concept of resilience inequality. And so you could write a paper saying, okay, there's Yuri and Markus, they're equally wealthy, they have equal income, but Yuri is much more resilient. And this actually has then some implications because Yuri is much more resilient. It is the case that he can take on more risks, so he can take opportunities I cannot take, and they will have a higher income down the road. And ultimately he will be more wealthy. So the resilience inequality will translate into income inequality and then translate into wealth inequality. And so you can analyze things which you start out with some resilience concept and resilience inequality, and then you see, how does this translate into the other inequality concept? So I think there are a lot of ideas coming from the resilience, which you can then link to other concepts we're working with, and perhaps also link it to the data. So you say, well, I can somehow measure. How would I measure resilience? So one way, which I describe in the book, is to measure. It might seem ex ante. How would you measure it? So one would be the economy is more resilient if the yield curve is more steep. Say.
Okay.
Why is that? Because if I have a shock and I know it's coming back, the interest rate we are getting depends on the growth rate of the economy. So, but if you always bounce back, it means that in the long run, the growth rate is fairly stable. In the short term, it might drop off, but can bounce back. So if the interest rate goes down because the growth rate goes down, we come back. It also means if the interest rate goes down, in the long run comes back, so the yield curve would be more steep. So one way to measure resilience would be the steepness or the slope of the yield curve. So there are many things one has to think about carefully. I think, how would I measure resilience? How would I relate different resilience concepts to other concepts we work with? So, and I hope the book touches on certain of these things, but there's, to formalize things and make it more precise and use the data to estimate things. That's, I think, a lot of things which are important. And finally, I want to say resilience and sustainability is very closely connected too. So if a system is not resilient, it's also not stable. It's not sustainable. So,
Yeah.
So it's a necessary condition, not a sufficient condition for sustainability. And if you think about all the environmental challenges we are facing, you want to also have a system which has more resilience. So there's a connection on that side. So there are many spaces, many dimensions you can actually use resilience and refine the concepts and think more deeply about them. I think it's still only the beginning. I hope, at least. Perhaps I'm too optimistic.
Yeah, I hope so too, and I also hope that it will be it will be able to infiltrate the policy debate a little bit more, because I think this is something, it's just a little bit more abstract than stability, and so it's difficult for politicians to talk about as well, I think. So Yeah, definitely. I hope this conversation has helped. I will upload it also on my second channel, Money and Macro Talks. Might take a while in an edited version. You can always look it back up on the homepage, and I will also edit some clips of it for the, if you're interested in specific parts. So check out Money Macro Talks. Check out Markus Brunnermeier's book. And with that being said, thank you so much for joining us on the Money and Macro channel, Markus.
Thanks a lot, Yuri, and I look forward to watching more of your videos on YouTube as well.
All right, excellent.
Really enjoyed it.
The next one will be on Russia's economy.
Okay, great.
All right. Yeah, cheers. Take care.